Hello, and thank you for watching IRTV today. I am Takeshi Haruna, Executive Officer and Head of Corporate Strategy at CELM. Today, I'll be walking you through our consolidated financial results for the fiscal year ended March 2026, the update to our midterm management plan announced concurrently today, and several related timely disclosures. Before getting into the results, let us start with our new management team. As we disclosed on March 31st, subject to approval at our 10th annual general meeting of shareholders on June 26th and the subsequent board resolution, Teiji Kashima, our current president, is scheduled to transition to chair of the board, and Takuya Inoue, our current vice president, is scheduled to assume the role of representative director, president, and group CEO. This is not a routine governance milestone. It's a strategic structural transition fully aligned with the next phase of our growth, the business foundation strengthening phase tied to the mid to long-term targets we're announcing today, operating profit of 2 billion yen and ROE of 30% or higher. So starting with the headline numbers for FY26, consolidated net sales reached 10.3 billion yen, the first time we've crossed the 10 billion yen mark, and EBITDA reached 1.66 billion yen, also a first for CELM, breaking into the 1.6 billion yen range. Profit at every level landed broadly in line with the full-year forecast we announced on May 13th last year. EBITDA in particular came in at 107% of forecast, and operating profit at 108%. While we front-loaded DX-related investments in Q4 to strengthen our mid to long-term business foundation, our consolidated EBITDA has continued growing at a CAGR of roughly 25% since IPO through FY26. Next, our quarterly trend in sales and SG&A. Q4 SG&A came in at the 1.1 billion yen level, a record high for CELM in any quarter. As we flagged in our prior quarter's earnings call, this reflects the productivity-focused DX investments we deliberately front-loaded into this quarter. Together with earnings contributions from KYT, now fully consolidated, we were able to absorb this elevated SG&A and still maintain a stable profit level for the quarter. Moving on to our segment results. For the talent and organizational development business, building on the customer base CELM has established on a non-consolidated basis, both the executives middle area and the competency assessment area drove steady performance. Demand for data-driven organizational design and talent allocation remains solid, and our competency assessment business, anchored in the caliper profile, continues to benefit from clear tailwinds. From our stakeholder relations business, the multilingual support area delivered over 2.4 billion yen in full-year sales and over 100 million yen in profit. Looking ahead, the real theme here is cross-referrals, leveraging the customer base we have in talent organizational development to drive group-wide synergies. That work is just getting started. Turning to our key KPIs. For our executives middle area, the number of client groups with annual transactions over 100 million yen came in at 13 against a plan of 17. That said, the budgeted sales themselves were exceeded. What we saw this year was more an overall lift in the average client transaction value than the deeper penetration of priority clients we originally envisioned in this KPI. For reference, the number of clients above 90 million yen was 18, and the average for our top 150 client groups reached 38.7 million yen, an all-time high. Our first career area landed broadly in line. KYT employee count stood at 45. The decline here is primarily driven by the conclusion of a specific client project leading to contract employee terms ending. We are now shifting our PMI focus toward optimizing the operational structure, agile reinforcement through outsourced and dispatched personnel that aren't captured by this headcount KPI, plus productivity gains through the overhaul of core business systems. EBITDA per employee landed at 6.8 million yen ahead of plan. From here, I'd like to walk through our updated midterm management plan applicable from FY27 onward. We've organized a review of client demand shifts and our strategic response into 4 themes. First, the increasing sophistication of our clients' management agenda. The requirements for executive talent are being redefined on an annual basis, and external hiring alone isn't keeping up. Persistent demand for an internal foundation to develop talent over the mid to long-term plan, which is exactly our executives' middle area, will continue going forward. Second, the shift in the labor market from labor shortage to in-house talent shortage. The right people aren't in the right places. This is a clear tailwind for the caliber profile we offer through our competency assessment area. Third, a shift in clients' new graduate hiring stance. With the rise of AI, structural views on human capital are changing. Particularly at large corporations, the absolute number of new graduate hire is trending down. This is a near-term headwind for our first career area. In FY27, we will position the year as a transition period, with business design work on expanding into the onboarding domain for newly joined personnel, including mid-career hires. Fourth, deepening our business portfolio. We will continue to expand from our historically large enterprise-centric customer base towards startups and mid-sized SMEs, advancing this inorganic growth path through M&A going forward. Building on these environmental shifts, we are setting two flags for our long-term vision. Operating profit of 2 billion yen as the FY29 target, and the ROE of 30% or higher on a mid to long-term basis. In our prior midterm plan, we set ROE of 25% or higher for FY29, but we've now raised this to 30% or higher for the mid to long term, reflecting the cash flow realities we expect post-IFRS adoption, and our intent to put the rigorous pursuit of capital efficiency at the core of our management. The earnings power that supports these targets we've structured as a 4-step flywheel. I will walk through each step next, but the key point is that these elements don't function in isolation. They reinforce each other, and competitive advantage compounds with each cycle. Under the new management structure, we'll be deliberately accelerating step 4, reinvestment, to a fundamentally more aggressive level. Step 1, a highly predictable revenue base. Our key clients in the executive's middle area are the Japanese large corporation with the sound financial fundamentals. By addressing structural management themes that are less affected by economic cycles, we secure stable, ongoing client relationships. The average annual transaction value across our top 150 client groups hits 38.7 million yen, an all-time high. And revenue from continuing clients in the executive's middle area accounts for the majority of sales, giving us a highly predictable revenue base. Step 2, variabilization through external talent. We operate an asset-light operating model leveraging our network of more than 1,700 external professionals. By avoiding the accumulation of fixed cost-heavy in-house talent infrastructure, we focus employees' core mission on dedicated partnership alongside our clients. That keeps our gross profit margin stable at around 50% and gives us a business structure well positioned to capture operating leverage. EBITDA has grown at a CAGR of 25% since listing. Step 3, stable cash flow from the core business. The strong cash generation that emerges from this thoroughly variabilized cost structure, EBITDA per employee in the 5 to 7 million yen range, becomes the funding for our next phase of growth investment. So step 4, reinvestment to strengthen the business foundation. By redeploying this investment capacity into our human capital, our organizational foundation, and the expansion of our business portfolio, we build a self-reinforcing flywheel that generates the next round of major business opportunities through deeper relationship with key clients. Each cycle compounds our competitive advantage, building a structurally hard-to-replicate engine of a sustainable earnings power. Now on our FY27 organic growth investment policy. Through rigorous adoption of project management methodologies and field-level productivity improvements, we will renew, upgrade, and bring our operational foundation into the next generation through DX, including AI. This is about eliminating dependence on individual expertise and delivering reproducible high productivity at scale. Takuya Inoue, incoming group CEO, will serve as a project owner for this initiative. By advancing strengthened executive leadership and fundamental investment as a single integrated effort, we raise the probability of hitting our midterm targets. We are moving forward with strong conviction that conducting fundamental investment at this point in time is the rational management decision, both for achievement of FY29 operating profit of 2 billion yen and for the sustainable enhancement of corporate value behind it. Concretely, we will pursue this fundamental effort to the level at which FY26 and FY27 ordinary profit remain broadly flat. On our M&A-driven strategy for strengthening the business portfolio, we will accelerate inorganic growth, expanding our historically large enterprise-centric customer base into new segments including startups and mid-sized SMEs. At the same time, by expanding solutions adjacent and related to our talent and organizational development business, we will add layers to the value we deliver to existing large enterprise clients, feeding back into deeper relationships. On financial discipline, we continue to set net debt to EBITDA of 2.5 times as our upper limit guideline for M&A investment, funding deals from the stable cash flow of our core business and verifying investment performance continuously as we move forward. On revisions to our capital policy and shareholder return policy, during the preparatory period for voluntary IFRS adoption from FY28 onward, we revised both our shareholder return policy and our ROE target, with a focus on strengthening our earnings base and reinforcing capital discipline. Our ROE target is now 30% or higher on a mid to long-term basis. On dividends, we're adopting a progressive dividend policy as our standard, with the prior fiscal year's dividend as the floor. This secures a dividend level that's unaffected by the accounting standard change associated with the voluntary IFRS adoption. We have also resolved today to conduct a share buyback of approximately 200 million yen, up to 550,000 shares. We will continue to consider further buybacks flexibly in light of market conditions. For reference, here's our group's typical seasonality. The executive's middle area peaks in Q3 as projects ramp up after the autumn promotion cycle. First career peaks in Q1, driven by new graduate onboarding programs, and KYT's multilingual support also peaks in Q3 ahead of the December fiscal year-end comment among their foreign-affiliated clients. Now, the FY27 full-year forecast and the image of Q1. Q1 is the quarter most heavily influenced by our first career area, which we flagged as facing a near-term headwind, so we expect a slow pace in consolidated quarterly sales and profit progress in Q1. From Q2 onward, alongside the build-up of our core areas centered on executives middle, we will prioritize strengthening the mid to long-term business foundation above all else, even at the cost of accepting temporary suppression of EBITDA and operating profit. As a full-year guideline, we will pursue investment to the level at which FY26 and FY27 ordinary profit remain broadly flat. And finally, the key KPIs reflecting our mid to long-term strategy in FY27. For executives middle, our target for client groups with annual transactions over 100 million yen is 17. For first career, our target for clients with annual sales over 10 million yen is 33. Both reflect our strategic intent of deeper account penetration with priority clients. EBITDA per employee is planned at 5.8 to 6.2 million yen, a deliberate step down from this year's 6.8 million yen. By temporarily reducing this metric to around 6 million yen, we position FY27 as the year for solidifying the mid to long-term business foundation. So that concludes our walkthrough of the FY26 full-year results and the updated midterm management plan from FY27. Thank you for joining us today.